Welcome to Finance Deep Dive. Okay, let's get right into it. We are tackling a massive puzzle in today's economy, one that's got millions of people scratching their heads, the U.S. housing market.
So here's the big mystery, right? It's something that seems to completely break the basic rules of supply and demand that we all learned. You'd think if sales fall, prices would have to fall too. But that's not what's happening. Not even close.
And when I say sales have plunged, I mean they've really plunged. We're talking about transaction volumes hitting a 30-year low. You have to go all the way back to 1995 to see numbers like this. The market is, for all intents and purposes, completely frozen.
And yet, despite that total collapse in sales, what did prices do? They went up by 1.7% year over year. I mean, it just makes no sense on the surface, does it? So let's dig in and figure out how on earth this is even possible.
Okay, so the real answer to this whole paradox, it's not about a lack of buyers. Believe me, there are plenty of people who want to buy a house. The real problem is, there is an incredible, shocking lack of anything for them to buy. This market isn't defined by sales, it's defined by pure scarcity.
You know, economists have a pretty fancy term for this whole situation. They call it structural sclerosis. Which, yeah, sounds complicated, but really, it's just a way of saying the market's gears are completely jammed. The whole system is seized up, and the normal ways it would fix itself are totally broken.
And here's the number that explains everything. Right now, there's only 3.3 months worth of homes for sale. Now, to put that in perspective for you, anything less than 5 months is considered a seller's market. So we are deep, deep in seller's territory. This insane shortage means that the few people who are trying to buy are forced into these crazy bidding wars for a tiny handful of houses. So who's the main culprit behind this crazy inventory shortage? You might be thinking it's some big, shadowy Wall Street firm buying everything up, but the answer is actually much closer to home. It's millions and millions of regular homeowners, and they're trapped by something called the lock-in effect. Just look at this chart. That huge blue slice, that's more than half of all American homeowners. We're talking 51.5% of them are just sitting pretty on mortgage rates below 4%. I mean, these are incredible rates they locked in years ago.
And those super low rates have basically become golden handcuffs. Think about it. For these homeowners, the thought of selling their house and buying a new one at today's rates, well, it's not just a bad idea. It's a huge financial hit, a massive penalty. Let's actually run the numbers so you can see what I mean.
Okay, so check this out. Let's say you have a $400,000 mortgage at 3%. Your monthly payment is about $1,686. Not bad, right? But if you were to get that exact same loan today at a 6% rate, your payment suddenly jumps to over $2,400 a month. That's a 43% increase for the same house. So why would you ever move? You wouldn't. People are staying put. And that means the only homes that end up for sale often come from what they call the 3 Ds: death, divorce, or default.
All right, so if nobody's selling their existing homes, you'd think the obvious solution is to just build more, right? Well, if only it were that simple. The short answer is, we can't, really. Building a new house has gotten ridiculously expensive, and a huge chunk of that cost has nothing to do with lumber or concrete. It's all policy. We're talking tariffs, nightmarish permit delays, and labor shortages. All this stuff adds what you could call a hidden tax of anywhere from $24,000 to nearly $38,000 to a new home before a single nail is hammered. And of course, you can't build houses if you don't have people to, build them. The country has a massive labor shortage right now. We're short almost 500,000 construction workers. And what does that mean? It means projects drag on forever, sometimes up to 14 months. And all that extra time and money, yep, that gets passed straight on to you, the buyer. Okay, so let's recap. Prices are sky high, mortgage rates are way up, and there's basically nothing to buy. And yet, somehow, the few homes that do hit the market are getting snatched up almost immediately. So the big question is, who in the world are these buyers? Well, it turns out there are 3 really powerful forces propping up demand. First, you've got millennials. They're the biggest generation in U.S. history, and they are right in the middle of their peak home buying years. Second, existing homeowners are sitting on a mountain of cash, a record $30 trillion in home equity. And finally, you have the cash buyers. These folks don't care about interest rates, and they make up almost a third of all sales. Now, I know it's really tempting to point the finger at big Wall Street firms, but the data just doesn't back that up. When you look at who these investors actually are, the vast majority, we're talking 92%, are just small mom-and-pop landlords. The huge institutions, they own less than 3% of investor homes.
So, the market is completely stuck in this gridlock. The natural question is, what are policymakers actually doing about it? And maybe more importantly, is any of it actually working?
Right now, we're basically seeing two completely different game plans. On one hand, you have the national strategy, which is all about stimulating demand, basically trying to make mortgages cheaper. The problem is, that's like pouring gasoline on a fire. It just gives more people more money to fight over the same tiny number of houses, pushing prices even higher. Then you have the other approach being tried in some cities, which is to tackle the root of the problem, unlocking more supply by making it easier to actually build. And we've got a great real-world example of this in Austin, Texas. They passed some reforms that made it way easier to build things like duplexes and triplexes. And guess what happened? Permits for those types of homes shot up by 86%, and it actually helped stabilize their local home prices. It's proof that this approach can work, and it might just be the path out of this mess for the rest of us.
So let's be clear about something. If you're sitting on the sidelines waiting for a 2008-style crash to happen, you're probably going to be waiting a very, very long time. The data just doesn't point to that at all. All these things we've talked about, the super low inventory, the locked-in owners, the steady demand, they create a really strong floor under prices. This market isn't heading for a collapse. It's heading for a long period of just being stuck, stagnation. And that really leaves us with the billion-dollar question for the future of housing in America. Are we going to see more places follow Austin's lead and really tackle the supply crisis head-on? Or is this it? Is this frustrating, gridlocked, and cripplingly unaffordable market just the new normal?
Thanks so much for joining this deep dive. If you like the content, don't forget to subscribe to Finance Deep Dive. It really motivates us to keep posting and breaking down these complex topics for you.